Welcome back to Primary Source China Investment. Peng Guo and I are here with show Y4. This week, JP Morgan dropped an 81-page chart-a-palooza on all things China. It covers the macro environment, fiscal and monetary policy, equities, fixed income. And of these 80 or so charts, Peng Guo and I are focusing on what we think are the top 6. We'll put a link in the description so anyone can grab the full deck. So without further ado, we're going to get to these top 6. And the first one up has to do with trade. So as you can see, there's the 3 different charts here, and let's take it piece by piece. The first one I want to look at is the one on the right, which is China's export by product. And what might have not clocked for a lot of people is this massive shift that happened in the 90s, whereas all the soft goods were in a steady decline and the machinery and electronics really ramped up. So when people think of, oh, everything is made in China. Well, not everything is made in China. Things are changing, and the nature of the products is changing as well. Whereas right now, machinery and electronics, and when you think machinery and electronics, there's a whole host of those type of products that are made in China now. And I think anybody that's bought a flat screen TV or anything like that knows those kind of electronics are coming from China. Peng Guo, any thoughts about this chart here?
This chart is not a surprise. It's pretty much consistent what we know in the past couple of years. Firstly, in export and import both get declined. For export minus import, that would be the net
contribution
balance.
to GDP. Yeah, net contribution to GDP. Yeah.
Yeah, that's will get increased. That really means if you see the reason, most likely is United States take the sanctions and China reduce and not China want to reduce. China was forced to reduce the import of the chips. That's probably contribution majority of the difference.
Yeah, the other thing you bring up there is interesting. The exports and imports as a percentage of GDP had been declining, which means consumption, government spending, and investment have been increasing. So the next slide that we're going to show is also related to trade, but it does show China's massive increase over the past 30 years or so in global trade. But most recently, you can see some pullback there. But what's interesting to me is on the right-hand side, China's major trading partners. And if you look, the United States is China's largest trading partner, right? The EU is big. All of Asia is also big, but the U.S. as a single country name is the largest trading partner, also has the biggest trade deficit, U.S. to China trade deficit. But also what people do forget is that the U.S., China is the U.S.'s largest export market as well. I mean, it looks small there, but it's the U.S.'s largest trading partner from the U.S. to China side.
Yeah, that's definitely interesting to know that. That really means 2 largest economy entities, they still have a lot of the complementary trade relationship, so they can benefit each other. And recently, like Warren Buffett also said, it's wise to still keep the positive relationship between those 2 countries.
So for our third slide, we would be remiss if we didn't talk about the housing market. And we have 2 slides on the housing and property market here. But one of the massive shifts in China has been the affordability index of housing. And if you look, China's largest cities are the most expensive cities to buy housing. So you're looking at a number of large cities in the world. I mean, everybody says, oh, New York is so expensive. From a housing perspective, it's maybe a quarter as expensive as Shanghai.
It's good to see this chart. That's definitely it's worth to understand what happened behind that. Obviously, I know, and everybody knows, in the house market, definitely is compared to the income is much higher than any other countries. We all know that.
Yeah, I think this is exactly what people are really worried about. You have the crowding out effect of real estate. It plays a huge role because it's so expensive. So people have to commit so many resources to down payments and to mortgages and to sustaining that apartment. And Go ahead.
Yeah, I think here is a little bit misleading. Is like the family disposable income. I bet they probably use Shanghai local people disposable income to do it. That looks very expensive. However, as I know, China, Shanghai, Beijing, Hong Kong, all those, including Shenzhen, is really like the international city. The majority of the buyers is not just from the local or ordinary people. It's really a lot of the international buyers. Plus, like the other areas, rich people come to this city to buy the property. I think the ratio should be lower than. I don't know the exact number, but it definitely should be lower.
Something we have to look into. Continuing with the theme, our next slide has to do with the property market again. And this is a little bit more on the macro level. So you can see the property prices and the volume of property really shifted in the zero COVID era. You had property volume really drop off. This is this orange chart here, which is total property volume year over year change. So that's probably what led to a number of the large bankruptcies we saw and the large defaults we saw with Evergrande and with Shimao. Those are two examples. There were Fantasia and a couple of other ones that went away also. But this is a very telling chart with respect to the largest property developers on the mainland. And if you look at the chart on the right, just very briefly, you'll see the source of funding for property developers, which has remained pretty constant with deposits and advance payments taking probably the largest share, and self-raised funds, which, that's probably pretty much equity. And then, the rest fills out the bar chart there. So we're going to transition a little bit on our next chart. This is my favorite chart, because this one, as colorful as it is, I want to zero in on one area here, which is this 10-year annualized return and volatility by sector. And the takeaway here is, if you look at the all share, the all A share, you have an annualized 10-year return of 7.2%. And then if you look at the volatility, all the way at the bottom, you have the all A share volatility in this area right here, which is 21.5%. So Peng Guo, you and I have been talking about this since the beginning of this channel, that your return and your volatility is not a good match. You take on way too much risk for the amount of return you're getting. And if you look at each of these sectors, there's no real winners here. Even consumer staples. Consumer staples has a 14% annualized return over this 10-year period, and it has a 23.6% annualized volatility. So there's no real place to hide. And that's why we always say you've got to have some fixed income in your portfolio.
That's exactly right. So that is the two-way. One is that is we keep saying track the each sector's uptrend, and in the downtrend try to avoid it. Most of the time, is a downtrend is probably around at least more than 6 months. So that means half of the time, if you come in, you will lose the money. Obviously, add the fixed income, it could reduce the volatility, at least make the risk and the volatility at an acceptable level.
So that's a good transition. Our final slide deals exactly with that, the returns and volatility of the China fixed income market. And you'll see a couple of different examples here, because remember, for US investors, you're going in US dollar. For mainland investors that have renminbi, it's a little bit different. On the left-hand side, this green and gray chart, you see a 10-year annualized return and volatility. So in renminbi, the annualized return for 10 years was 4%, and the volatility was actually lower than the return, which is pretty amazing. For US dollar holders, it's less attractive. You have a 2.8 and a 5%. So right now, if you're looking at Chinese bonds or Chinese government bonds, you might be saying, well, the US 10-year is doing better than this, so I'll probably just hold US 10-year, which is totally reasonable. US rates have come up a lot, but you just match the volatility of the government bonds on the mainland versus the equity market, and you can see that the volatility is really, really low for the amount of return you're getting.
Yeah, I think this is definitely a good chart, but they should add additional chart to see what's the real return minus the inflation over the 10 years.
Yeah.
Or
yeah.
at least compare with the M2 growth and what it looks like from the purchasing power perspective. I bet probably most of bonds should be the negative return.
Well, that's a great point, because a lot of the investors that, the high net worth individuals or even the corporates, they're not owning these kind of bonds. They're just going to simply buy some wealth management product. They're going to buy some other alternative deposit where the banks are going to give them a better rate, something like a CD, but they don't call it a CD. So this is a short-term deposit that a bank will offer to a large depositor, and they're going to beat this return a lot. And then even a few shows back, you mentioned the IPO market is like the risk-free rate, because people can just simply, if they get an allocation, they can make 10% on their money in a quick pop. So there's a lot of funky stuff going on, but just try to get an apples to apples comparison so investors can look at what they're facing over a 10-year period.
Yeah, and most of the time, why the CD become hot, that really means the market crisis.
Yeah, that's exactly right, because people want to hold cash, but the market crisis came after a huge bull run, and then people are like, I still want that return, but I don't want the risk. So investors are irrational all over the place. So that's not new to China. Well, we're going to leave it here with this show. Thank you so much for tuning in, and we'll see you next week.
Thank you.